Hi there. Thanks so much for joining us for this great panel on the ECB to follow up on Philip Lane's remarks, which he just made. I'm Megan Green. I'm a senior fellow at the Harvard Kennedy School and at Chatham House, and I'm joined by a really esteemed panel, so we're in for an interesting conversation. Just to provide quick introductions, we've got Vitor Constancio here, who's a professor of economics and business administration at the University of Navarra, but also, of course, the former vice president of the ECB. We've also got Peter Pratt here, a former ECB executive board member and former chief economist at the ECB, and also serving as a senior fellow at the Solvay School of Economics and Management at the Université Libre de Bruxelles. And finally, we're going to be joined by Lorenzo Binismaghi, who's the chairman of Société Générale, and of course is a former member of the ECB executive board. So we've got three really distinguished panelists, all of whom know all about the ECB, but none of whom are at the ECB, crucially. So hopefully we'll have a frank and interesting discussion. Now, we just had Philip Lane's remarks in which he discussed the outlook for the Eurozone and for the ECB, and there weren't any real surprises, I don't think, in there. Most of the uncertainty he suggests is, further out in 2021. So in terms of growth and also in terms of inflation, he suggests that this is a common shock. The ECB is welcoming any sort of ideas that EU institutions have in terms of ways to provide fiscal solidarity. But Vitor, I wanted to throw this to you and see what you think of Philip Lane's outlook for the Eurozone, how the growth outlook really jives with you.
Well, he was very much on message, I would say, and he was mostly non-committal about the different possible scenarios. So I don't have to be so non-committal, of course, now being out of office. And unfortunately, my view is a little bit more pessimistic than the two of the scenarios that have emerged from the ECB, the very mild one and the intermediate one. And I am closer to what they call the severe scenario, perhaps not exactly as severe as it is, but closer to it, meaning a drop in GDP this year around 10%, and then a very slow recovery. Which means that the Europe, and not only Europe, by the way, my view is the same about the US and other parts of the world. So it's not different in that respect. Of course, it's not only about economics. It's very much dependent on the virus itself, as Philip said. But the WHO, even yesterday, told us that the second wave is strongly likely to happen. And if it happens, even if it is not so intense, nevertheless, it will be again disruptive. And so until we have a vaccine next year, widely applied, then the economic activity will continue to suffer. And then the recovery will be subdued and very slow moving, very sluggish for various reasons. There will be, of course, loss of capacity. Trade is affected, and it will take time to recovery. And now we have a full-fledged Cold War between the US and China, which is now evident for anyone to see, including by the recent document issued by the White House about the American strategy towards China. We have, of course, we are going to have bankruptcies and defaults in emerging countries and so on. And there are some sectors that we'll see from now on a structural deficiency of demand. They are not going to recover for the previous levels of recovery. Households will be also saving more than before. It has happened always after major crisis, an increase in the savings rate, and investment will suffer. And on top of all this, we may have in certain parts of the world, Europe being one of them, possibly an impact on banks that can affect credit supply. Going forward, it's not immediate, but going forward that may happen if the more sort of severe scenarios will materialize.
Yeah. Okay. So you're quite a bit more pessimistic than many at the ECB, at least, are admitting that they are.
Well, all international organizations cannot be alarmist and cannot go talking about more severe scenarios. That's the normal behavior that everyone has to expect. And so it's very understandable what all of them are doing at this stage.
Yeah. Well, and you highlighted the demand shock that we're experiencing, and I think most people are really focused on that. And off the back of that, five-year inflation swaps have fallen for the Eurozone to under 1%, right? Which suggests the ECB isn't going to be coming anywhere close to its inflation targets for a long time. And in fact, they haven't really come close to their targets for a long time over the last recovery of, there's a supply shock to this as well. And so some economists are saying, actually, we're going to have a huge jump in inflation off the back of this. Peter, what do you think is right in terms of the Eurozone in particular? Will we see deflation, or are inflationary forces more of an issue?
Well, I think for me it's very clear that deflationary forces will dominate for a while. Yeah. The supply shock that you mentioned normally pushes up prices in some sectors, not necessarily everywhere. And then the question is, are you going to have a permanent price increases, basically from the supply side, or transitory? If transitory increases of prices, the answer for monetary policy is relatively straightforward. The central bank has to look through, even if inflation goes up because of these supply side negative effects. Now, more difficult for the central bank would be if, because of lower productivity becomes more structural, and then the capacity, the output gap that you have now will be impaired more permanently. That would be a much more difficult situation for the central bank in determining the stance of policy. But I think what Victor is saying is quite right. I mean, before you get back to the GDP level that you had before the COVID shock, it will take 2 years. So I think what will happen with the savings ratio in this period is probably that people are going to be very careful. Basically because public finance will continue to be under pressure. Nobody wants to talk about this for the time being, of course, but the political and the social tensions will be quite important in the recovery phase. You see that already in countries like France, and it will be in other countries the same, lower GDP level. And so the sort of political social tensions to see who's going to foot the bill is going to be there. And therefore also monetary policy will be quite important, in that sort of context.
Yep. Okay, that makes sense. And do you think productivity might fall off the back of this?
I think it's a very big question. I mean, if you ask me, I think certainly productivity is falling. The question is looking forward, do you get permanent, negative supply shock, which makes it much more difficult for the central bank to look through. But anyway, my conclusion in the relatively short, medium term, 1-2 years, the deflationary pressures will dominate.
Yeah. Okay. And, the ECB has stepped in with an alphabet soup of new measures, the PEP, TLTROs with new rates on them, PELTROs. But it's not the only central bank that stepped in. The Fed, of course, has moved a huge distance. Even emerging market central banks are now engaging in QE. Lorenzo, can you sort of compare and contrast a bit the ECB's response to this with other central banks and give it kind of a grade?
Well, you have to take into account in this comparison the different structure of the economies, of the capital markets, of the banking system. But if you project the measures that have been announced so far, I think by the end of the year, some simulations suggest that the size of the ECB's balance sheet will be around 55% of the total GDP of the Eurozone, and the Fed will have between 55 and 60. So it's broadly comparable, I would say. Actually, in light of the reliance in Europe on banks as a main channel for the financing of the economy, I would say that ECB has done quite a lot. Actually, it's providing credit at minus 75 basis point or even minus 1%. I would say that I would just add to what Vitor and Peter said that there are two issues to take into account to assess what central banks will have to do. One is the savings ratio and the deflationary pressures. The other is the preference for liquidity. So the portfolio allocation by financial institutions and savers in general towards more liquid assets. And if risk aversion will remain very high for a long time, I think we will have the central banks staying in the markets for quite some time before there is a new appetite for risk. So I would think that the ECB, especially if the environment goes in the direction suggested by Vitor, will have to substantially increase, and not only the ECB, increase its program, and be ready to avoid tensions in the credit markets, which may arise maybe 1 year from now or two, when the markets will have to assess the overall size of the debt of the public and private sector, and some tensions may arise, and some shift to liquidity may arise, and there only the central banks can provide the liquidity.
But you think that's about a year or two off, that we get some kind of market pressure then?
Well, I think once say we have a bit more certainty about the dynamics of growth, then people will say, okay, which countries can afford this amount of debt? It's more or less it's what happened in 2010, 2011, after the 2008-9 crisis. 2 years after, markets looked around and said, well, maybe some countries cannot afford this debt, and they started, the credit spreads started widening, and there, we had to wait at that time to have the whatever it takes, but now we have it. So hopefully the central banks know better now than in those days.
Yeah, well, and it's true. You can't really do a debt sustainability analysis when every economy is still on quicksand, and we're still figuring out how deep the hole is that we're going to need to dig our way out of. But Peter, the ECB is meeting soon. They're giving their projections next week. What do they need to announce next week? What do you think they should do in the immediate term if real market pressure is further down the line?
First, I think they did very good job. So they were very flexible, reacted, with very strong measures. It's the first point. I think it's important for the future. The second is, I think, from also what Lorenzo just said, we go from a sort of crisis mode reaction with temporary measures, the pandemic purchase program, very flexible and all that, to a more, permanent presence in the market in the future. That's a very delicate move. You remember that in September 2019, still under Mario Draghi, there was this coherent framework about, interest rate guidance, purchase guidance, reinvestment and all that. Then you got a shock, with temporary measures, very flexible. At some point, I'm not saying necessarily for June, but at some point you have to reintegrate, the exceptional measures in the more normal framework. So I think the price stability has to come back in the core of communication of the central bank, and not only the market stabilization support that you see now. That will be a move, which will be quite delicate. I think in June they have to start with, basically what they probably will do is what market expect is increase the size of the pandemic program. But I think personally, you should, the more difficult exercise would be to try to plug in, the exceptional measures more in the framework, which was developed basically in September 19. And with all the guidance framework, it's difficult to conciliate the two together. That will be quite a difficult exercise. Also, considering the German Constitutional Court, which, is a little bit behind, all these strategic, thinking.
Yeah. Okay. And I should just remind viewers that I'm weaving questions from you in as we go along. So please submit them over Pubble, the app. We've talked about the PEP, which is a bond buying program. And of course, it's not just sovereign debt. The ECB has been buying up corporate debt for a really long time. It has actually been ahead of the Fed, far ahead of the Fed in that. The Fed's just started to dip a toe in. So, Victor, how do we think about the ECB taking on corporate debt and the risk that involves? How much credit risk should a central bank take on? How much is the ECB willing to take on as well?
Well, some risk is taken, of course, but nevertheless, the program is predicated on buying just investment-grade corporate bonds. So that is already a risk management measure. It doesn't mean that in few cases there may be losses. There has been one case since the beginning of the program, but that's not relevant. The program as a whole has not been at all a loss-making program for the ECB. So it entails a certain amount of risk, but it's contained. And it has been important because both when we started in 2014 and more recently, we saw that the amount of new issuance increased in the market, which fills one of the two main tasks of central banks in this crisis, which means taking care of credit supply. In this case, credit supply via the bond market. And it's very important, and the Fed had to do it, although the Fed had to ask for a legal permission because they had no legal competence to do it before, which is not the case in Europe. Nevertheless, another difference is that the ECB takes the risk. In the case of the Fed, they buy, but part of the risk, first loss, guarantee is provided by the Treasury, and I don't exclude myself that if the crisis would become much worse later on, the ECB would have to extend some of the programs. I'm not referring to the PEP specifically. I think if the crisis next year would not be ended and the recovery would be too slow, for instance, a possibility would be for the ECB to embark, like the Fed, in purchasing loans from the banks with the Main Street facility that the Fed has created. And for that purpose, perhaps a guarantee from the treasuries would be very convenient.
Will the ECB ever pick up high yield debt like the Fed has done?
Well, I really don't see it. I also don't see the need in the European context, which is different from the US financial market structures. In a way, the Fed embarked into so many things that then some borders with other segments became difficult to manage, and they have to embark into a little more. This is not the case, I think, in Europe.
Okay, so the ECB is more conservative, it seems, in terms of the credit risk, maybe.
Up to a point, but one has to think that the Fed has some important 450 billion of first losses that have been provided by the Treasury, right. 450, which can then be the basis for programs up to $4 trillion, as Jay Powell has said.
Right, and there's no Treasury in the Eurozone to provide that kind of first loss guarantee. That's true. What about the sovereign debt?
They could do it, of course, if they would be willing. And if the ECB would ask strongly for it for certain types of programs.
Yeah, that makes sense. What about risk appetite on the sovereign side, Lorenzo? Do you see the ECB continuing to pick up risky sovereign debt, even if it's downgraded? Is the PEP big enough? Does it need to be expanded? What happens if we get a kind of July 2015 situation with Greece when the ECB said, you know what, we're done. We don't want to be buying this stuff up. We don't want to be helping the banks through the back door. Do you see that potentially being a scenario in this crisis?
Well, I mean, right now, the monetary policy is aimed at creating enough liquidity for the markets, supporting the economy, looking at inflation. If we get into a scenario like the one I was mentioning earlier, in which there were doubts in the markets about the sustainability of some debts, at some point then you need to ask yourself, what about the OMT? What about other instruments? to stabilize the economy. Of course, the debt sustainability, the question you ask is fundamental. I mean, how do you assess the sustainability of the debt? Of course, the interest rate and the rate of growth of the economy are key. Now, with interest rates close to zero, nearly everything is sustainable. It depends a little bit on the primary surplus and on the rate of growth. We have to see what kind of rate of growth we have in 1 or 2 years' time. But I would say this would be a different mode from the one we have right now.
Right. Okay. And in terms of what the ECB can really buy for sovereign debt and corporate debt, at least, it's beholden to the capital key, sort of, kind of, though not really anymore, but actually over time, they have to even it out. Should the ECB just get rid of the capital key? Is that at all possible? And engage in yield curve control like the Bank of Japan, which might ultimately just be a lot cheaper. Vitor, I'll send this one your way because I know you've written on yield curve control.
Okay. Well, there are two questions there. Regarding the capital key, yes, they have committed to, in the end of the program, to converge to the capital key. But the deviations so far have been quite significant. Very justifiably so, because just for the PEP, for the temporary pandemic emergency purchase program, and that was warranted because the objectives of that program were indeed very much focused on the smooth transmission of monetary policy towards all parts of the monetary union and to avoid fragmentation, as the ECB has said many times in written form. If those are the objectives, then the deviation from the capital key makes all sense. And as the governor of Bank of France, François Villeroy, said yesterday, he hinted that indeed that divergence is indeed necessary. In my view, now they have committed to a convergence. In my view, what they will have to do in the end is to announce later on that the convergence will take a few years to be implemented. And then as they have to keep reinvesting and not declining the balance sheet for a number of years, for all the reasons that we have talked about, then they can converge via reinvestment policy, the composition of reinvestment. I think that's the reasonable thing to do, and I expect that's what they will have to do.
Peter, I saw you. Oh, sorry. I thought you were done.
But no, I was to the first question. You had a second one.
Yield curve
control.
The
yield curve control.
Oh, the yield curve control. Well, yes, it's a possibility in a different way from Japan. I have talked about that several times since I left office, because in the case of the euro area, the central bank cannot have, or even less so, can say, leak to the markets a target for the medium-term yields of 19 countries. That would be really impossible. So the possibility of having just yield curve control would be for the ECB at a certain stage in the future to say, we are concentrating our purchases in 5 to 10 years maturities. And that, of course, would impact that longer maturity zone of the yield curve, which would be a way of indeed having an influence on the shape of the yield curve without announcing or hinting about any concrete targets, which would be impossible in our case.
That makes sense. I saw Peter smile when you were talking about evening out the capital key. Peter, do you think, first of all, do you think the capital key will actually ever be evened out, or if anyone will actually care and still be paying attention? And do you think the ECB is ever shrinking its balance sheet, or are we all just kind of stuck with this stuff?
I think it will take many, many years. And so I was laughing because Victor was talking about a few years. So it may take more than a few years.
Oh, yes.
I think there are different questions. One is a very important question for all central banks is how much credit risk do you transfer from the private sector to the central bank balance sheet? I think what Vitor was saying about the US, it's quite important to remember that there is an equity tranche, which is which comes from the Treasury. I think we have to think in Europe and certainly in the euro area about how to use, this fiscal capacity to leverage it. And one possibility, if things really turn bad, which is not yet sure, but if it turns bad, we have to think about things like this, where you could create, asset management company, which first losses, which would come from the government, and the central bank could provide some funding with a very little risk transfer because of the equity tranche was really from the government. This is complicated politically, but in terms of engineering, it's quite straightforward. I think the Fed is a good example of what we could do. The second is on the banking transmission channel, and that's linked to the previous point. It's when you look at what the ECB has done, in the TLTRO 3 and the minus 1% funding for lending at relatively easy terms, the price to book ratio of banks, major banks in Europe, has remained between 20% and 30%. They were already very low before the COVID shock. Now they are incredibly low. And in spite of these measures which have been taken. So this is a major concern for the future and the recovery. So I think one of the reasons we have to think very carefully about what are the reasons, and you really need to give more perspective, to the banking sector in general. So I'm referring to the banking union and the capital market union. That's not this discussion today. But I think it's very important in the future to give perspective to the strategic perspective to the banking sector. I think that's not a small thing. No. The last point on yield curve control, I think it's not only yield curve control, it is spread control. And when I say for the next meeting already, I think in communication, the ECB should think communicating on this is you need at some point to reintegrate, things which were designed recently for the short term, temporary measures like the PEP, with the framework which was developed in September 19, with all the guidance machinery about interest rates, about, reinvestment and about purchases. And so I think you should do this rotation from crisis mode to a more structural sort of policy where price stability comes to the forefront as it should be, of course, because, supporting markets is a secondary objective, of course. The first objective is price stability. And I think the ECB next week will have to say more about, how they see the inflation in the medium to long term. I think, no, Vitor, you say no, but I think they cannot be evasive as they have been now. No, of course, it still remains uncertain, but I think that the deflationary pressures remain dominant, and that should be said.
Okay. No.
That's
again, if you want,
the primary mandate of the central bank is price stability. So
you are right.
You cannot say that you are uncertain about the future. You have to have view on that. That's my point.
You are absolutely right, but June is too soon to
could be too soon. I agree. I agree.
Could be too soon. Later in the year.
We agree, Vitor.
Let me ask Lorenzo to also weigh in on this, but also Lorenzo, I want to ask you about the banks because
I wanted to.
And European banks, if you look at the equity markets, have been performing terribly. Are investors right in terms of their bets on European banks? What is the status?
Well, I wanted to elaborate on what Peter said. I mean, in the end, the stock prices are what they are, but the issue is whether there is a macro problem. Right. And I think policymakers have not understood at all what is a problem, in the sense that the banking system has been quite resilient so far to absorb the shock. So if you ask yourself, is there enough capital in the system to absorb the shock? Well, so far we've seen the EBA answers, and so far it looks like there is enough capital. But the second question, which is more relevant for monetary policy, is there enough capital to support lending to the real economy in the recovery? And there the answer is clearly no. So the risk that I see is that there is not enough financing to the real economy, even if you bring interest rates down to whatever they are, simply because there is not enough capital, given that there is a ratio of lending to capital, that is the biggest risk, that the banking system in Europe as a whole is not able to provide enough lending. Now, how can you increase capital? One is to make profits. Well, in the environment going forward, low interest rates, with the regulations we have, with no capital markets, and so on and so forth, it's unlikely that there will be a lot of profits to be held in the banks to support growth of credit. Second is to go in the market and raise capital. But the key issue is who is going to put money into banks which are highly regulated, where you cannot distribute dividend, where interest rates are low, where probably there are, for some time, NPLs to absorb. So, some people are saying, the banking system in Europe is not investable for some years. And third, the alternative is public money. But if you put public money into the capital of banks, you have the bail-ins and so on and so forth. So my concern is that the banking system as it is regulated today, without a capital market where you can unload part of the balance sheet, is going to be a bottleneck for financing the economy and for growth. And then the only solution could be that the central bank buys parts of the balance sheet to free banks capital to allocate to new lending. But this is a major issue in Europe, which is not the case in the US, because in the US, with the capital market, the banks can securitize and sell parts of the balance sheet and use again the old capital which has been freed. So this is an issue which in Europe is not sufficiently understood and is going to be a problem for growth over the coming years.
Okay, but what about the TLTROs? Is that not a way to finance the banks? So I'm going to actually send this to Peter. The TLTROs, the new ones that haven't been issued yet, are a huge subsidy to the banks, right? The banks get paid 100 basis points if they lend on to the real economy. So is that not a way to improve lending? The take-up for the last TLTRO, which also had a subsidy to the banks, wasn't actually that great. So why not? Will this next one have a better take-up? And is it really supportive of the banks and of lending to the real economy?
I must say I agree with Lorenzo, what basically he said. I think the TLTRO is very important at -1%. It looks a little bit like an act of despair. You need more structural responses to the banking sector. That's what Lorenzo is saying. I fully agree. Now you need to change a number of things before it brings a solution to the problem. So I think the TLTRO take-up will be quite huge. But looking forward, the question is basically the structural issues that have been mentioned by Lorenzo. The question that we discussed before also about how much credit risk can you transfer to the public sector in general, the central bank. You remember that the ECB had in 2005 a rating threshold of A. It was investing, A was A plus, I think, even at that time.
A minus.
A minus. It was A minus. Then in the collateral you are below triple B minus in the collateral that you accept today. So for the purchases of government paper is still investment grade. I think it's a big question for the future to say, you are still relying on ratings of a few rating agencies for your, the risk behavior of the central bank. I personally think it should not be. I mean, it's an important discussion, quite delicate, of course, because you don't do that in crisis times in principle. You should do that in good times. But I think this is a serious issue. And I think we should seriously come back to what happened in the US where, Lorenzo, you say they don't know the risk to the market. Yes, for a big part, but also a big part to the central bank, but with backstops, equity tranches from the government, from the treasury. I think we should think of that if things do not evolve well. I hope we don't need to go into that, but we have to be ready for that.
But if I can, Peter, the governments are guaranteeing right now bank lending. Instead of guaranteeing bank lending, maybe they should guarantee central bank lending, to some extent.
Right.
Up to a point.
Well, that's what they do in the US. Yes, they give, as Vito mentioned, the 450 billion sort of first loss that the treasury will take. And on that basis, the central bank can buy a lot of loans, the Main Street program. Now we'll see how it goes. I think that's a good idea.
I mentioned it before, and it's important. I agree with both Lorenzo and Peter on what they said about the banks and the bottleneck that they may they may constitute indeed. So buying loans is something that has to be indeed considered going forward. Also because the states, the governments are providing guarantees to bank lending, but not 100%. In all those loans, the banks run credit risk. And in some cases, they don't want to take that additional credit risk to firms.
They cannot.
Yeah, they cannot.
Because they don't have enough capital.
And that's one reason why also the pickup of the TLTRO is not as big as expected, because they are not expanding.
Well, we'll see. But
they are not expanding. But of course, there is a substitution where they can earn money if they go. But there is a condition to benefit from the -1% loans from the ECB, which is that they have to keep the same level of credit to the economy. And so it's a condition that perhaps some of them cannot comply with, and so they will not benefit from the -1. So the whole equation of supporting credit supply in Europe, so dependent on the banks, it's a big, important thing to be more deeply thought going forward. And perhaps if the situation goes to the worse, which it may be, it's not at all certain, but it may be, perhaps then in the end, going forward, even public money will be necessary. And in that case, if that will emerge in, say, any significant scale, then it's the BRRD that will be at stake.
Yeah.
Europe suspended the Stability Pact. It's suspended. And perhaps the suspension will have to continue next year. So if the situation for the banks will become really serious, and we don't know, then at that moment, also the BRRD will have to be suspended.
Right.
So we cannot exclude these things. Is the situation for the banks being a bottleneck and needing more direct support becomes an important thing for growth in Europe.
Great. Now we're running out of time, but I just want to pose two more questions to you. Lorenzo, we can't not talk about the German Constitutional Court. So really quickly, we're talking about everything the ECB is doing. Has the German Constitutional Court really just thrown a bomb into this? And how constrained will the ECB, if you've got a quick take on that?
Well, I think first, maybe it's one of these things that we are lucky to have a lawyer on top of at the helm of the central bank. At least she knows what risk can be taken from a legal point of view. But and since she looks quite confident, I think it means that they have looked at it quite closely. I don't think that that this will refrain the ECB from doing what it needs to do. I think the legal case is flawed. It's flawed legally. It's flawed economically. It creates an embarrassment for the German government, an embarrassment for the Bundesbank. It's really a shame, in my view. We are in the midst of a crisis, and frankly, we didn't need that. Hopefully, they will find a way out for the court to save the face, because really there is no economist that I know, sensible economist, that thinks that the reasoning is sound. Not to speak about the legal issues.
Right. Okay, and then I'm going to ask you each to give a 20-second answer to a huge question, which is, the ECB's been the only game in town so far. Do you think that's going to continue to be the case, and is this sustainable? So, Peter, I'll start with you.
Well, I think it's a fact that the ECB is not anymore the only game in town, because you have fiscal. The question is, how will the partnership between the two evolve over time? And for the time being, interests are aligned, because of low inflation and price pressures. Now, looking forward, we don't know how the partnership will evolve in the future. So for the time being, it's okay. It's not the only game in town. It's a partnership. But how will, the partnership evolve? It's a big question. Okay,
Vitor, I'll go to you next.
Well, I agree. Fiscal is becoming more important, and particularly now, the new German-French proposal, if it goes through as expected, it's indeed a very important change, and which I hope, by the way, will then become more permanent in what should be a stabilization fund that Europe should have on a permanent basis to really support the moments of deeper recessions from the fiscal side. That has been something that has been lacking in the monetary union, and this is an harbinger of perhaps that needed structural reform.
Great. And Lorenzo, you've got the final word on this.
Yeah, no, maybe we should avoid that fiscal and monetary are the only two games in town. And we need the real economy back. And I think we need in Europe to work a lot on structural reforms, not to lose pressure on that. Italy is one of the countries which needs to do a lot of structural reforms, but we need to build a true European single market and, coming back, a true capital market in Europe where companies can raise capital and risk can be better distributed. This is key, and this is the responsibility of European Parliament and the European Commission in particular.
Yeah, and sadly, the country that was the biggest proponent of a capital markets union just left the EU, the UK. But, well, I think you're right. We need one, and I hope we can get there. Let me just quickly thank all of our panelists for your great contributions, and thank the audience for tuning in. We're going to have to wrap up here, but please stick around for the next panel. Thanks a lot.